Hello traders, Gary Wagner here. Approximately 10:20 a.m. in Honolulu, Hawaii. It is Monday, the 12th day of September, and this is the daily report for gold. We have gold trading off of its lows, but under extreme pressure today, trading off almost $50 at one point. Traders, we currently have the market down off about $43. 1850.60. It's at 1840.95, right in that area. We did issue a buy signal this morning. It is an aggressive buy signal, and the reason for the buy signal is that as we see this market sell off, we had our first real sign of support, and that support came in roughly at $1,800 per ounce. You can see that right in here. This is our old low, and this is that higher low right now. For that reason, it is my belief that we could see a nice bounce here. One of the things that we have to realize is that, yes, we do have a stronger dollar, but one of the reasons cited for this very, very large sell-off is the fact that as the equities market sold off, and they sold off because of a panic over the European debt scenario, which we believe is bullish for gold, as the market sold off, the stock market, profits were pulled in gold to cover margins. That's at least according to Bloomberg. Now, with that scenario in mind, it seems likely that once this knee-jerk reaction is thought out, realize, traders, that the fact that the European Union is having some issues is extremely bullish for the metals markets itself. And that was the primary reason for taking a look at this particular trade, this trade from the long side. Realize that global markets right now have faltered across the board, and investors, according to the street, are selling their gold to cover losses in other assets. We will see how this pans out, but my belief is that if this market is going to maintain some balance, we will see some sort of recovery, and we will see the market find some support at $1,800 per ounce. Now, traders, if you recall from Friday, I'm talking about two different types of potential corrections that we're going to see here. One being our standard correction, that's here on the upper right, and the other one is known as a triangle correction. It's a much more shallow correction. Now, the first thing that I want to look at is this triangle, because on the surface, when we take a look at it, you can see that we have reached some lows that have gone beyond. You would have had to hold it about 1820, 1825 or so for this particular line not to get really hit. Now, when we take a look at this 1815, of course, the signal we issued was right around 1816, so right in this area, you can see that there is a small body doji that's almost hammer-like. And it is that doji type candle that we have seen that also has brought some interest in terms of entering the market from the long side. We will typically get that type of a candle at the bottom where you've got an exaggerated low. The exaggerated low comes in, and then you have a open and close that are fairly similar. Also, when we look at this from a 360-minute candle chart, you'll notice also that you get this piercing line structure. You don't have confirmation yet. That's why it's a high-risk trade. A lower-risk trade would be to wait for the secondary candle to form, but then, of course, we would be back up at around 1840 if, in fact, that was right, and we would be giving away some of it. That was my reason for initiating the call this morning. But as you can see, you will typically get this type of activity, whereas on the longer charts, what we're noticing here is a marketplace that's giving us this piercing line. On the shorter term, we got that doji-like candle. Now, traders, when we take this out to a 720-minute chart, we are getting the long exaggerated low that we got, and as you can see, that low found buyers at $1,800 per ounce. Because when the market did come down to this area, as you can see, at 1800, buyers did come into the market. They pushed it off the lows and they pushed it back up. They haven't pushed it up so significantly yet, but again, around the 1816 area, which is telling me that there is a good opportunity to buy this particular dip. Traders, it is my sentiment, it is my belief currently that if in fact this sell-off is due to concern over the European debt issue, then this is a knee-jerk reaction in which they're liquidating to cover other positions. Money should go into gold. That is my belief, and that is the reason we issued the buy signal. We're sitting roughly in the same area that we were. We have our stops in place, and they are well under the $1,800 mark. Where we found support, we'll have to see over time exactly what this market wants to do. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.